So the broad market bolted out of the gate with some gusto. 10 out of 11 sectors started trading higher, all in the green. But of course, we know all eyes are on the short squeeze names led by GameStop. They're under pressure right now as Robinhood has extended limits on how much investors can buy on its platform, including limits of just one share. If you want, you can buy one share of GameStop or 5 options. Now, of course, this story has captivated the nation, becoming something of a modern-day David versus Goliath tale, where individual investors are trying to best the hedge funds that have mostly operated with impunity when it comes to shorting. One thing lost in the conversation is where the arguments for buying these names before the short squeeze. There really were. Viewers of this show know I was pounding the table on brick-and-mortar retail survivors last year and had a number of grand slams, including Bed Bath & Beyond and Gap stores. Think of some of these short names, and there are some stories to them. I mean, AMC, they secured $1 billion in financing and recently said job postings are up 128%. Virgin Galactic had more good news today, fundamental news. In fact, many of these announcements over the last week. The point is the narrative that these names were doomed. Also, we remember that was Best Buy not long ago. And of course, eventually, all of these folks who believed in this doom scenario lost $60 billion shorting Tesla. So what have we learned? And more importantly, what comes next? I'm going to bring in Ironsides Macroeconomics Managing Partner Barry Knapp, along with Strategic Wealth Partners Investment Strategist. Can we put some initials or something? You guys are too important. Luke Lloyd. Hey, Barry, let me start with you. And I was reading in Forbes where you made some really interesting comments. You said, when I look at these shorts, I thought, who the heck would be shorting movie theaters, brick-and-mortar retailers, and airlines when we're just beginning to clear bottlenecks in vaccine distribution? And for GameStop, you saw positive changes within the company, pointing out that online sales had surged and customers are lining up outside to buy those new PlayStation consoles. So why do you think the shorts picked on these names, and why was the narrative that they were all doomed to go out of business in the first place?
One of the big missing pieces of this entire narrative is the business cycle elements to this. And the first thing I thought of when the story really started to percolate was back in 2003, after the 2.5-year bear market and after the tech bubble burst. And I recall some very big hedge funds who overstayed their welcome, short internet companies with very challenged business platforms. In 2003, when the recovery really started in earnest, these stocks just exploded. They were long the quality names, short the lower quality names, and got eviscerated on that trade. The same thing happened in 2009 with very weak financial companies, mortgage insurers and the like. This is very early business cycle activity. And so to me, I flippantly described it in my research this week as skating to where the puck was a year ago, right? And cyclicals have been outperforming tech going all the way back to the midi big cap tech bubble in the summer. But that low quality rally really began in November and just exploded last week. And if you think about what was happening last week, we were going from less than 1 million vaccines a week to now the 7-day average is 1.4 million vaccines. We've had vaccine days over 2 million. And the most draconian lockdowns in the country, like New York City restaurants, are being lifted. It just seemed like a very stale, sector or parts of the market to be short.
In the meantime, though, Luke, 2 Fridays ago, we were ahead of everyone talking about this big short squeeze things, right? Everyone else in the financial media caught up last week. But we had this discussion, and you kind of went off, right? You said investors who were trying to squeeze these names were actually going to get crushed. You still feel that way?
Charles, I thought GameStop's momentum might fade after it reached close to $100 a share based on the valuation, but we've all seen how valuations can be thrown out the window for now. Wall Street bets and retail investors have a lot of firepower. The stock market is a big transfer of wealth. Some make money and some lose money. That's how the market works. Retail investors are making millions, and I think it's an amazing thing. A new term that's being thrown out right now, though, on Wall Street bets is having diamond hands and never selling. Do I believe that they should do that? Absolutely not. When you are right and right big on an investment, take some money off the table and play with the house's money. The biggest killer to these stocks is losing momentum, and once momentum fades, you don't want to be left holding the bag. My biggest issue, though, are the brokers limiting access to these stocks. I'm a firm believer in the free markets, free speech, and free opportunities and access to opportunities. The American dream is still alive, and killing the stock's momentum by restricting access is one of the most uncapitalistic and un-American things that I've ever seen.
Luke, I want to stick with that, but shift it to Bitcoin because it's made a big move here recently, in part to Elon Musk. And many are wondering if maybe it's found this support, right? Maybe north of 33, 32,000. And if that is the case, where could the next leg in this go? Because this is another one of those diamond hands things for a lot of people.
As you know, Charles, I think Bitcoin can reach north of $100,000 in the next year or two. But at the same time, you have to consider these recent factors into the equation. First, from GameStop to Dogecoin going 10x in a matter of a day, I do think the SEC will soon come out with some stance on crypto. This could be a headwind to momentum in the short term, especially if that stance isn't fully supportive. Second, Bitcoin broke out around $24,000 and headed to $40,000 without any trouble along the way. From a technical standpoint, I think a retest of $24,000 is in the books. I sold my Bitcoin at $40,000, and I'm looking to add it back at $24,000 for the run to 100K.
Barry, I want to switch back to the broader market because I read where you were saying buying the dips is, quote, absolutely the right thing to do. Why is that?
The business cycle is just exceptionally strong. If you think about this cycle relative to the last one, we don't have household debt at extreme levels. We don't have financial sector debt at extreme levels. We've created even more or expanded the monetary base to a greater extent. And this time we will get the pickup in velocity of money. So those cycle elements are strong. Policy is a risk. You know, we'll have monetary policy related normalization shocks later in the year and throughout the business cycle. Public policy is a risk. We may get those tax hikes pulled forward. But on any decent drawdowns, particularly if we can get a 10%er out of this, then I would be a buyer with both hands, and primarily of the inflation beneficiaries, the cyclical sectors, industrials, financials. That's really where you want to be positioned early in the business cycle.
Guys, I got 1 minute left, and I want to go around the horn. Just the biggest risk then, because it sounds like for the most part, both of you are very opportunistic here. But I'll start with you, Luke. The biggest risk for this market right now, in your opinion?
I think it's inflation. By pumping all this money supply into the markets via stimulus, spending, and low interest rates, the risk of inflation obviously increases as well. Go to your local restaurant and compare prices a year ago from before the pandemic to now. I know when I go out, my favorite restaurants have risen prices significantly. Do I blame them? Absolutely not. They're trying to survive after being forced to shut down by those who are supposed to be looking out for them. But at the same time, do I think these prices will ever go back down? Absolutely not. If inflation runs hot, the Federal Reserve will be forced to raise interest rates, which would derail equity valuations and market momentum.
Barry?
I think it's the risk that those tax hikes, the Biden tax plan, gets pulled forward. A doubling of the capital gains rate is worth one S&P multiple, so roughly 5%. A hike in the corporate tax rate is worth another 5% or so off the equity market. For me, it's policy, and that is we're getting them one way or another. It's either later in the year or sooner.
Yeah. And they better not be retroactive if we do get them later in the year or next year. Barry, Luke, thank you both very much. Fantastic conversation.